Hey guys, JC Parets here of StockCharts.com, and welcome to the show. So as we always like to do, I want to just sort of reiterate what we're doing here. We're going to do three things. The first thing we're going to do is always take away a lesson, right? What's the lesson of the day? And so make sure that everybody always walks away with something, usually something I've learned the hard way. And then let's look at some charts, right? What the heck is going on in this market? What are we looking at next? What's got our attention? What do we want to avoid, et cetera, et cetera? And then let's take some questions, right? Everybody's always got questions. I get a zillion questions a week. I get questions every single day. And man, I say it all the time, but I am incredibly fortunate that the people who read our work are really smart. So the questions that we get are really good questions. And the ideas that we get are really good ideas. I mean, it's internally, it's like a joke, right? I message the team. It's like, guys, look at this chart. And they're like, where'd you get it from? One of our clients? I'm like, yeah. Shocker, right? It happens all the time. So please fire them in. You can, let me just show this. You can just email info@allstarcharts with questions, and we'll answer them right here. All right, so first thing we want to do, lay out a lesson. What's the lesson of the day? This is something I learned from Jeff DeGraff, who runs RenMac. He was at Lehman Brothers. In my opinion, he's one of the best technical analysts in the world today, no question. And he's one of these guys. He's kind of like a technician's technician. You talk to a lot of technical analysts. Obviously, I do, and many people agree. Anyway, the ones that know who he is or follow his work, and I certainly do. Highly recommend the CMT Association podcast that just came out with him and David Lundgren, who also happens to be a favorite technician of mine. It's not like some random journalist is asking Jeff DeGraff questions. It's David Lundgren. And Tyler Wood, director at CMT Association, also jumps in, asks some good questions as well. Highly recommend. If you can't find it, email me. I'll send you the link. But go to CMT Association website. You should be able to find it. And I think iTunes too, probably, if I'm not mistaken. All right. So what's the lesson? This comes from Jeff DeGraff, which was my point. Something Jeff DeGraff taught me a long, long time ago was the first thing we want to do is identify the market environment that we're in. What's the market environment that we're in? And then we decide what tools and strategies we want to incorporate to best take advantage of the scenario that we're in, right? The circumstances, so to speak. Then we want to build the scans, right? So the scan that I want to show you today is a scan that we like to call the Young Aristocrats, right? And I'm going to show you, I'm going to pull this up right here. What the Young Aristocrats are stocks that are showing an unusual, These are stocks that have raised their dividends for 5 to 9 consecutive years. So why are we looking for this? Some of you guys who have been around for a while are familiar with what are called the dividend aristocrats. And the dividend aristocrats are companies that have raised their dividends every year for 25 consecutive years. Think Coca-Cola, Procter & Gamble, Johnson & Johnson. These have raised their dividends, I think, like 50 plus years, right? It's an interesting list of stocks, the dividend aristocrats. We want to stay one step ahead of the curve here. So what we're looking for are stocks that have raised their dividends consistently for between 5 and 9 straight years. And one thing that you'll find is that the yields aren't very high, right? But that doesn't mean that they're not paying a dividend. It just means that the price has appreciated consistently enough where the yield itself, even though the dividend continues to increase for 5 to 9 consecutive years based on the scan, in many cases it's still very low. You want to be careful with those super high dividends because in many cases they're not able to pay. They're not able to pay it. My fundamental associates like to point me to the payout ratio, which shows the amount of their earnings that they're actually paying out. And if it's, low in the 20s and 30s, that's good. If it's too high, it's unsustainable. That's sort of how that relationship works. But forget all that. The point of this scan is to have a list of stocks. All of this is a list of stocks that have raised their dividends 5 to 9 consecutive years, low payout ratio. The most recent increase is great. And then we're sorting by new highs. We're sorting by relative strength. We're sorting by positive momentum. And then what we're going to have to do then is hand select the best risk versus reward opportunities if there are any available, and usually there are, right? We have other scans like the minor leaguers report, which we're going to touch on, the under the hood report, which we've discussed on this show, which looks for stocks that are showing unusual increase in investor interest. We've got the 2 to 100 club. It's actually dropping today. So these are different scans that we use depending on the market environment. But it's funny because we know, I was making the metaphor yesterday. It's like, when you live in a fishing, let's say you live in the Florida Keys, you know where to go fishing, right? You know where the reef falls over, there's a wall, you know where the fish are hanging out, you know where to go fishing. And when we build these scans, it's kind of like that. We know that from the stocks that do well are showing these characteristics, whether it's, the filters that we use for the 2 to 100 club or the under the hood report, or in this case, the dividend aristocrats. So, okay, fine. Great, JC. So we build that scan. We get a list of stocks. Now what? Well, now we bring in the humans. And the humans are going to go chart by chart and look for the best risk versus reward opportunities. So here we're looking at Aon. I don't know if you guys know anything about reinsurance. I happen to know a little bit about that, believe it or not, kind of random. But I do, and I know Aon's a big player in that space. I also know really smart dudes are in that space too. You've got Berkshire Hathaway. I think it's, is it Gen Re? I don't know. Berkshire Hathaway's big into the reinsurance business. I know Stephen Cohen is in the reinsurance business as well. These aren't dumb folks. Anyway, that's a little side note. The reason that we're in the stock has nothing to do with any of that stuff. The risk versus reward profile is fantastic. Look at Aon, A-O-N. And we want to be long the stock if it's above the early 2020 highs. That's the trade. If we're not above the 2020 highs, right around here, here we go. If we're not above the 2020 highs, we cannot be long. We can only be long if we're above that. So I want to give you the exact, give me 1 second. I want to give you the exact levels. Off the top of my head, it was 238, but I don't want to misspeak here. The exact levels are 238. Yep. So Aon 238, target is 297, just below 300. Listen, this is if you're interested a little bit more, that they pay a small dividends, about 0.6%, but they continue to increase it actually 9 years in a row. So it's about to graduate out of our Young Aristocrats list. So we're catching it just before that, which is great. It's fantastic. And so again, if we're not above 238, can't own it. If it's above 238, I like it long. And if you're interested in these slides, please email info@allstarcharts.com. Peter will send you the slides, but make sure to include the password. I give a lot of presentations around the world, and if you use the wrong password, you're going to get some random presentation. It's not this one. If you want this one, use the password Young Aristocrats. Now, okay, so that was a Young Aristocrat scan. I got another bonus for you at the bottom of the show, so take a look. Stay patient. I will be right back with more Young Aristocrats in a minute. All right, let's get intermarket. What do we know about the U.S. dollar? The U.S. dollar bottomed out. Well, first of all, the U.S. dollar peaked in the fourth quarter of 2016, right after the Trump election, right when stocks started to explode. 2017 was one of the greatest years ever. And as you guys know, the U.S. dollar got absolutely slaughtered, right? Okay, dollar getting slaughtered, stocks doing great. Terrific. Dollar bottoms. January 2018. What happened in January 2018? Risk peaked. So as the dollar's ripping for the next couple of years, stocks did poorly. Don't look at the NASDAQ 100. Don't look at the S&P 500. Look at all the other indexes around the world. Trust me, risk peaked in January of 2018, right? Dollar ripped. Then what happened last March? The dollar peaked. What else happened last March? Risk bottomed. Stocks exploded, commodities, et cetera, all over the world as the dollar was getting killed. Very similar to after the Trump election, right? Now, what happened in the first quarter this year? The dollar rallied. And guess what? Stocks have been pretty messy, haven't they? Right? So, former resistance and the dollar index is turning into support. I've been in the camp that if risk is going to be on, if you will, money's going to be allocated to risk assets, particularly stocks and commodities, we're going to need to see this dollar rolling over. Right? Now, we've been rolling over for a week or so. Today it is down again a little bit anyway. This is a big one. You know, in life, you've got your wants and you've got your needs. Hate to say it, but I think the dollar rolling over and stocks continuing this rally, I think you need it. I really do think you need it. Now, let's dive into the US dollar index. There are multiple components: Japanese yen, Swissy, euro, British pound, Aussie, CAD. Look at yen getting slaughtered. Swissy not looking good. Euro hasn't been looking good. Neither has pound. Strength has really been in Aussie and particularly in Canadian dollar. These are the more commodity-centric currencies, folks, particularly Canadian dollar. So what does that say to me? Well, first of all, shout out David Cox. David Cox is a portfolio manager in Toronto at CIBC. Just had him on the podcast. Gives a great Canadian perspective. And this podcast episode, go to, you can search iTunes for Technical Analysis Radio. Go to technicalanalysisradio.com. Go to allstarcharts.com/podcast. Again, you can find it. It's not hard to find. Or email me if you can't find it. But David is very, very smart. Old friend, CMT, CFA. He's got like every letter in the alphabet, this guy. Loves taking tests. Anyway, portfolio manager, super smart guy. This is a really fun conversation. It's great because me and David have been having these conversations for years, just that nobody ever gets to hear them. I'm like, David, like, give the world access. Let them eavesdrop on our chats. And he's like, yeah, I'd love to. So great guy. Listen to the podcast. And what I really enjoyed about it is that you're getting a Canadian perspective, but the information he's providing is for investors of all kinds. U.S. investors in particular, he thinks have a huge advantage moving forward with what's happening in Canada, including the Canadian dollar, which is a tailwind for American investors. Really, really fascinating stuff. Highly encourage you. So while we're on the topic of Canada, for me not to bring this up would be a shame. Now, speaking of, so when we're thinking about commodity-centric currencies outperforming, Canada outperforming, if that doesn't say crude oil, geez Louise, what will? So what do I see here? I see us knocking on the door a few times, huh? It's only polite to knock on the door a few times before you go barging in, right? And the more times the level is tested, the higher the likelihood that it's going to break. If this is a fourth test, we're going to be running into the 66 level for the fourth time, which I certainly think as I'm recording this, crude oil is at 63. It's only a few points away. That would be the fourth test of this level. Knock, knock, knock. Let's rock and roll. A breakthrough 66. I think you're looking at 76. Take a look at the XLE, the OIH, the XOP. These are all the different energy industry and sector ETFs. Take a look at those. They look very similar to crude oil. So the next leg higher, in my opinion, is likely to get going. If this was a gap and go in that group this morning, which as I'm recording this, we're only halfway done with the day. I hate to, make interpretations like that with incomplete information, but something as we're recording this, the energy in general has the potential to be, I don't know, the beginning of November again. Remember what happened at the beginning of November? This could be that again. A breakout above 66, I think, takes us to 76, and I think has a lot of international and intermarket implications. Again, I think the dollar's going to have to weaken in that environment, it doesn't have to do anything, but my suspicion is if that's happening and crude oil is ripping, stocks are doing well, the dollar's probably under some pressure. I want to point out dollar ZAR. This is the dollar versus South African rand. So as this is declining, South African rand is increasing in value relative to the dollar. We're at a very critical level, right? So you're at a key Fibonacci extension level off those former highs. You got that uptrend line from those 2011 lows. So there's a lot going on here. A break here in dollar ZAR, I think, is a positive catalyst for risk assets, commodities, the whole thing. Speaking of risk assets, lumber just absolutely on a tear. On a tear. I mean, when my wife's grandfather is asking me about lumber futures, like we might be a little long in the tooth, as they say. We might be a little bit of froth, but his credit, I may have brought up the conversation, so I don't know if we could use that. But regardless, new highs in lumber across the board. And it makes sense, highs in lumber with the new highs that we're seeing in steel and rebar futures, what we're seeing in base metals in general. It makes sense that lumber's doing well. There's obviously a lot of demand and building going on, right? Because it's not like lumber's ripping and the others are not. Like they're all doing it together. So here we're looking at the lumber gold ratio to make things even more obnoxious. And we're making new highs. Like The demand is in these materials to build things, in copper, in steel, in rebar, lumber, not gold, right? In fact, gold is down 7 out of the last 8 months and down every single month so far for 2021. Gold has been the worst place to be in the world, except for bonds. There's been nothing worse than gold. And I think this chart shows that, right? So this is a more obnoxious version to look at the new highs in lumber, steel, rebar, and that growth. And in addition to that, a lack of a defensive trade, right? Which is what gold is. So they don't need that defensive trade is essentially what the market participants are telling us, right? So that's how I see it. That's how I interpret that. And then that should probably be happening in an environment that stocks are doing well. And as messy as some of these indexes have been, some of these sectors have been since February, probably around there. We're making new highs in the Dow Jones Industrial Average, Dow Jones Transportation Average, semiconductors, S&P 500. What do we know about new highs? We know they are not a characteristic of a downtrend, right? These consolidations are resolving higher one by one. I think that's positive. Granted, this morning's, I think, is influencing how I'm saying that, but this chart is from this weekend. So this is what we call new Dow Theory. So, old school Dow Theory, you've got the industrials, you got the railroads. This is from 1800s. You didn't have semiconductors in the 1880s, in case you guys are wondering. For you youngsters out there, semiconductors came much later. But the thought process by Charlie Dow was you got the companies that make the goods, those are the industrials, and then you got the companies that deliver those goods, and those are the railroads. Ultimately, they changed it to the transportation index because you've got airlines, you've got the truckers, and all other things that are not just railroads. So the Dow Jones Railroad Index became the Dow Jones Transportation Index. So when one's making new highs, the industrials, transport should be making new highs as well, confirming that. When they're not confirming, there's a divergence, there's a heads up, something might be wrong. Same thing in a downtrend, right? If industrials are making new highs, transport should be if industrials are making new lows, transport should be making new lows also. When they're not, there's a heads up, something's wrong. Fine. And when you hang out with my nerdy friends at the bar, these are the things we argue about. Like, how are railroads the way that we deliver goods today? That's bullshit. That's 130 years ago. Our goods and services are delivered through the internet, through semiconductors. And it's like, all right, I can't argue with that. So then it's like, do we use the old school Dow Theory? Do we use new school semiconductors? And the answer is we use both, which is a really common theme, where at our shop, when we run into these forks in the road, which way do we go? Which way do we go, George? Which way do we go? When it comes to like international indexes, for example, do we look at them in local currency or do we look at them priced in US dollars? The answer is both. When you look at equally weighted sectors and indexes, do you look at the cap weighted indexes or do you look at the equal weighted index? The answer is both, right? So do we look at old school Dow Theory or new school Dow Theory? The answer is both, right? And both, neither one of them are showing divergences, right? New highs in industrials and transports. And then when you include semis and S&Ps, all making new highs, right? So needless to say, no divergence, right? So there's nothing to see here like Kevin Bacon at the Animal House. All is well. Remain calm, right? So meanwhile, volatility index broke that key 20 level, which we've been pointing out forever. Sean, our options trader, always said, when you see the VIX break 20, that's the market signaling that we're out of this mess. Maybe he's right, maybe he's not. We broke 20 right around when I got my vaccine, and everybody seems to be getting their vaccine. So that theory seems to be playing out pretty well. So kudos, shout out Sean. The way I interpret this is, it's almost like there after the crash, there was a new floor of volatility at 20 when it used to be 10 to 12, right? So my argument is, if we're going to go back to that old floor of 10 to 12, the path to get there is the VIX dribbling down towards single digits. What does the market environment look like if that's happening? And my argument is things are probably looking pretty good, right? Stocks are probably doing well. Commodities probably doing well. Interest rates probably going up. Bonds probably going down. Gold's probably not having a bid. And what's been happening? That, right? So if that continues, which there's no evidence so far that that's not going to continue. In fact, that's the bet we're making, right? That's in my opinion, the highest probability outcome is that the VIX just dribbles down. And let's remember what the VIX is. It's a derivative of the S&P 500. It's called the fear gauge because when, the market is really selling off, people are going to pay more for insurance, right? People are willing to pay more for insurance when the storm is there. Of course. Classic, right? All right, so that continues to dribble down. It's got to be positive. And then looking at breadth, this weekend, I'm like, we new highs in all the indexes. Where's the new 52-week highs? Like, they're just nowhere to be found. And you know where they are. They're in the large caps. They're not in the small caps. So there's your answer. Where's the lack of new highs to confirm the index new highs? Well, you're getting the confirmation in the large caps. You're even getting somewhat confirmation in the mid caps. You're just not seeing it in the small caps, right? And that's a function of the fact that the indexes themselves and a lot of the stocks are stuck below their February highs. So until small caps are able to resolve that, and based on what we're seeing, some of these indexes are resolving their consolidations higher. I think it's inevitable that the small caps do too. And at the end of the day, they had a hell of a move, small caps, right? Got to give them a break. I think that's probably pretty well deserved. So anyway, if you're wondering what the new high list is, here's your answer. When you look at some of the weaker areas as well, emerging markets have been one of the weaker areas, no doubt, along with small caps. In order for the indexes to really sell off, you need the components of those indexes to sell off. In other words, you need to see more stocks making new lows for the indexes to make new lows. And they're not going to show up on the new 52-week low list because, market bottomed a year ago. Most 99% of stocks are nowhere near new 52-week lows. So you're not going to see breadth deterioration showing up on the new 52-week low list for a while, right? It's just math. Where is it going to show up first? It's going to be a process. You're going to see it on the 21-day low list and the 63-day low list. 21 days represents about a month, by the way. 63 days represents about a quarter's trading. So that's why we use those numbers. So we're just not seeing these spikes yet, right? So even in the ones that have struggled the most since the first quarter peak, you're just not seeing, breadth deterioration. You're not seeing an expansion in new lows. You're just not seeing that, which is necessary for the indexes to themselves to go down, right? You need the ones driving it to drive it lower. And that's just not what's happening, at least not yet, right? So we'll keep an eye out it's going to show up on the 21-day low list before the 63-day list, obviously. Well, maybe not obviously, but yes, this is math. In many cases, simultaneously. So we'll be watching that. We haven't seen that yet at all. By the way, again, if you're interested in these slides, info@allstarcharts.com, and make sure to use the password Young Aristocrats so that you get the right slide deck. All right. Great, JC. Intermarket analysis, blah, blah, blah. I get it. You look at the copper gold ratio and the dollar and all these things. I understand. But what's the damn trade? So we developed the trades using these top-down methodology, right? We're looking at energy stocks as we speak, as we get that rotation, for example, and that stems from the strength in Canadian dollar, the strength in oil itself. To not look at energy stocks right now, look for trade ideas seems silly, right? That's the top-down approach. To supplement that top-down approach, we have these bottoms-up scans. We talked about the Young Aristocrats at the top of the hour. Let's talk now about the minor leaguers. The minor leaguers report comes out every other Monday. Minor leaguers is where we scour the farm system, if you will. These are specifically stocks between $1 billion and $2 billion market cap. So we want to, ask any old timer, go back and do the math. The best winners, biggest winners of all time come from mid caps, come from the mid cap space. So we are catching these names before they graduate into mid cap status. Again, all of these names are between $1 and $2 billion. We open it up to all sectors and industry groups. The 2 to 100 Club, for example, is only 13 industry groups specifically. This one, we open it up to all of them. As you can see here, a lot of banks keep popping up on these, a lot of regional banks and stuff like that, some REITs. So it's a very diversified group of stocks, some semiconductors, biotech. We had a huge winner in biotech recently out of this. The one that stood out to me the most is a trucker. It's a global trucker, ARCB, so ARC Best Corp, ARCB. I love how it's breaking out on a relative basis to new highs and looking to break out once again. So 74.5 is the level there. This one comes from our minor leaguers report, ARCB. We only want to be long ARCB, ARCB, if it's above 74.5. So if it's below 74.5, we don't want to own it. If it's above it, I like it long with a target of 112 to small cap trucker, right? So it's an industrial stock, if you will, more specifically a global trucker. Now let's take it back to the Young Aristocrats report that just dropped hot off the presses. This is one of my favorite scans. It was inspired by Straz's father, as a matter of fact. One of our analysts' dad. He's the one who inspired this report because he loves, he loves the high dividend payers. He's no dummy. He's got a few years on us, and he's an accountant as well. So he has seen, not just with his own portfolio, how much dividends add up over the years. I'm sure he's done a zillion people's taxes and seen a million people's portfolios and seen the success that they've had through those dividends. So it comes from a good place, comes from a place of experience. And man, when we ran the scan, we started running the numbers. They made a lot of sense. And sure enough, a lot of the folks out there seem to really like it. A lot of investors. So shout out Mr. Straza. One name, we talked about the Aon at the top of the hour, but another one is Owens Corning, OC. So 97 is the level there. We only want to be long Owens Corning, OC, if it's above 97, with a target near 139. And Sean stepped in. Sean is our chief option strategist. He took a look at this. This one got him all excited. He likes buying the OC November 115 calls for around about $3.50. So these are the OC November 15 calls for $3.50, right? So this debit is the most we can lose. So no matter what, the stock can go to zero. The most we can lose is the premium that we pay, right? So there's already an inherent level of risk management already inherently in the trade. You can't lose more than you put in. Great. Now, an additional layer of risk management is that $90 level. If we're below that $90 level, we agree that it's probably best to take whatever's left in premium, take what we can get, and move on, which I think is interesting. From an equity standpoint, I think you leave it alone unless it's above 97. Only be long if it's above 97. On the option side, we could use 90, getting involved with a November 115 strike call for $3.50, and it's April, so May, June, July, August, September, October, November. We're looking at 7 months out. That ain't bad. That ain't bad at all. Implied volatility is low here, so it's an interesting name that Sean pulled out. Let's talk a little bit about crypto here before I let you guys run. I've been paying myself in Ethereum, which I think is hilarious. Fortunately, that's been working in my favor. When I tell people I've been paying myself in Ethereum, they think I'm ridiculous. But hey, it seemed like a good idea. So chalk one up for the good guys there. Let's see how long that lasts. But here, talking my own book, Ethereum breaking out of this consolidation relative to Bitcoin. To me, that's not evidence of risk aversion in the crypto space. That's evidence of risk appetite as far as I'm concerned. Not bearish for Ethereum, right? I'm looking at about 2250 on the Ethereum. 2250 is the level there. Do I have it up? Let's see. 2250. Yeah, that's the level. So 2250 is the level I'm looking at there. That was the next target as far as I was concerned when it broke out above 14 and a quarter and then went down to retest it. The next level was 2253 because that's the 161.8% extension of the entire 2017 to 2018 decline. So 2250, if you see it consistently holding above that, right? Because these levels, it's more about how the market reacts. If the market barely reacts to this 2250 level in Ethereum, I think that's really, really impressive, right? The less it reacts to it, the less it acknowledges it, the more bullish it is, right? And the next target would be about 3,600, which is still far, far, far away. We're going to talk about all of this and more, folks, on Saturday at the Chart Summit. Check it out. Email me if you can't find the invite. Go follow me on Twitter. And then we'll send you the invite, and make sure to email info@allstarcharts.com, password Young Aristocrats to get the slides. Thanks, guys.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.